Oh boy, this is going to be so much fun. Why? Because today we start our long march towards stocks, exciting stocks, sexy stocks, risky stocks. Yeah. So let's start with a couple of quotes here. This is from Will Rogers, a humorist from the early part of the 20th century. Don't gamble, take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Yes, his generation knew all too well the dangers of stocks. They were destroyed by the crash of 1929 that ushered in the Great Depression. For 2 generations, people were terrified of stocks with good reason. Because how do you make a small fortune in the stock market? The answer is you start with a large fortune and you then make a small fortune. Oh, yeah. Oh, yeah. Can stocks make us wealthy? Well, we already saw through our previous 2 chapters that yes, over the long term, stocks can make us wealthy. But does that mean it's a straight line? No. And does it happen overnight? No. Well, for a scant few people, but it ain't going to be us. We're going to take the long route, prudent, long term oriented investing. Yeah, I think so. Okay, so you decide. And if you want to be a speculator, a trader, buy and sell, good luck. Slide number 2, stocks. What are stocks? Well, they represent ownership in a corporation. And as I've mentioned, I think the word stock is very unfortunate. Actually, the legal term is common stock. Now, do I just want plain old common stock? Yes, as a matter of fact, you do. You don't want preferred stock, as we'll see later on in the semester. A couple people might, but for most part, they're not for us. They're for corporations. But the term common stock came from the idea that the shareholders in the corporation were shareholders in common. Every share had one vote. And the more shares you had, obviously, the more votes you have to determine the direction of the corporation. And if you have 50% plus 1 share, then you basically run the whole operation. The companies, these corporations, started in the 1600s when the new world was being colonized, and entrepreneurs and people who were venturing forth needed capital, which is a fancy word for money or resources. And so they would sell shares of the corporation to raise capital. That's the idea. Stocks are equity financing. We hear the word equities. Are you in bonds? No, I'm in equities. It means the person is investing in stocks. They enable us investors to participate in the profits and growth generated by the business enterprise. But unlike a partnership or a sole proprietor, the stockholders are limited liability owners, where they can only lose their investment. Unlike a sole proprietorship or a partnership, where if you and the business are one and the same, and if the business incurs these debts that cannot be paid by the business, they can come after you for the money. That's not true with a corporation. Now, there are some people who attempt to use corporations to shield assets and get away with hanky-panky. One of them was a president. But the courts will sometimes pierce the corporate veil. You will hear that term. And you would learn more about this in our Introduction to Business class, Business 120, and our Business Law class, Business 140. So why would you invest in stocks? Well, stockholders receive optional distributions, optional payments of earnings. Those are dividends. They're optional. And you could think of them like interest payments, but legally they're different. And if the company does well, if the business grows, that we should get capital gains, capital appreciation. But we can also get capital losses if the company doesn't do well. In fact, we can lose everything. And some people do, depending on the company. Contrary to what many people believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper. Well, now it's all electronic, that people trade each day. They represent ownership in real businesses, the companies that are tasked in our capitalist system to feed, clothe, and shelter us, along with thousands other products and services that they offer us, some useful, some not so useful, but it's your money, right? I wonder sometime what people spend their money on. I just think, okay, that's their decision. I'm not going to tell them differently. What's the historical performance? Over the long sweep of time of modern finance, and we won't go into the historical reasons, but let's start from the early 1900s, early 20th century. The return from the stock market has averaged 10, 11%. As I said, we'd like to tell people 8, 9, 10%. Don't get their hopes up, although it's done better. Some stocks have done a whole lot better. But in any one year, it is unlikely that the return will be 10 or 11%. The return has varied from a high of 53.8% to a low of 43.4%. And 2008 was 38.5%, one of the worst. And that just counts 2008. But from peak to trough, from the high to the low, it was over 50% drop. And in any given year, there's been about a 1 in 3 or 1 in 4 chance of a down market. Recall our discussion of standard deviation, right? There's about a 2/3 chance that will be in between around, minus 7 to 30%. And so we don't know what years are going to go down. You might think you know what years are going to go down. You might believe, and you might actually be right and think you're a genius. But all the studies show that in the short term, 3, 6, 9 months, it's random. And there are some people who can time the market, but not too many. In fact, there's a wonderful saying, don't try to time the market. It can only be done by liars. Bernard Baruch, a famous investor of the mid-20th century. So here's a graph that we showed you in chapter 1. It shows from 1928 to 2021 what happened to a dollar in the stock market. And it looks like it's a straight line going up, right? Wrong. This is a logarithmic scale. Logarithms are not something you should use with the vast majority of us who don't really understand that it's not 1, 2, 3, 4. It's 1, 10, 100, 1,000, 10,000. So here's bonds. Stocks have returned almost 6,000. That $1 has turned into 6,000 since then. Bonds have turned $90, and it looks like bonds have done about half, right? It looks like bonds, about half what's wrong, right? 10 to 100 times better than more than 100 times better than stocks. So stocks are where it's at, folks. You can lend your money, and you can do pretty well. Certainly better than the short-term investments that we get from a bank or treasury bills, if you remember our discussion of short-term investments. And you've beaten inflation in all 3 instances, but look at what the economists call opportunity cost. By putting your money in safer investments, you lost the ability to earn this quite substantial sum. But again, this looks like a straight line, but these little dips, folks, they're not little. They're big because of the logarithmic scale. Now, there's a problem. If we tried to show you an arithmetic scale, the bottom 3 wouldn't even measure. All you'd see is that way up in the air exponential growth of the stocks. and that's why we use the logarithm. But it's the misleading. It masks the true nature of owning companies that do well, and this has been an incredible time in history since the dawn of the, the industrial revolution, the industrial age. Our standard of living has just increased exponentially, and it makes sense that the stock market would follow because these are the companies that are producing that standard of living. And of course, when we go to a longer term, the numbers get even bigger. When we start back in 1800, we see that, yeah, it looks like a straight line, but again, it's a logarithmic scale. And it looks like bonds have done half the size of stocks. No, no, bonds have done what, 10 to the fifth power, 1,000 times, 10,000 times, 100 times, 1,000 times better than stocks. Yeah. So again, those little squiggles, though, those little downs, they're not little. They're painful. And there's something that we're going to learn to live with. Right? Of course, right. Let's now take a look at rolling 10-year periods, because I think this is a very, very good graph here, because it shows you what happened over 10 years since right before the Great Depression. So these are rolling 10-year periods, folks. You put in $1 or $1,000 or whatever. What did you get? And then you went off on a deserted island for 10 years. How did you do? Well, in the Great Depression, you lost money over 10 years. Right. And it was a very difficult time, and many people were questioning whether capitalism was actually the best system. There was a large alternative. People were talking, well, maybe we should be communists. Of course, the Soviets were papering over how bad their system really was. And people thought, well, let's try communism. Well, it didn't turn out so well for the Soviets. And then there's that middle ground socialism that is a mixture of the two that has worked in some countries in Northern Europe. So, nothing's perfect. But look at this. We come out of the Great Depression, out of World War II, and we see the 10-year rolling periods just climbing and climbing and climbing until you see almost 20% over 10 years. The go-go 50s out of the Cold War and the new science and technology. And what did you hear people say here, right here? Oh, is it too late to get in? And when you start to hear people say that, whether it's Radio Corporation of America or whether it's the Science Calcomp and Tektronix of the 1960s, and you've never even heard of those companies, whether it's the dot-com revolution in the late 90s or whether it's cryptocurrencies and non-fungible tokens and real estate in the 2006 and 7 area. When you hear people say, "Ooh, is it too late to get in?" that usually means it's too late to get in, because there they were, folks. Stocks had done so well. They were very expensive in the late 60s. And sure enough, we had a very difficult time. The 1970s were a very difficult time for the economy, for the culture. We had the civil rights, women's rights, gay rights, the Vietnam War, Watergate, and the first oil crisis in 1973. But the biggest problem with the 1970s had to do with the demographics. And often the economists will say, follow the demographics. Now, demographics is just a fancy word for studying the population. And there was a huge baby boom after the World War II, which resulted in this huge bubble, where I'm a boomer, baby boomers. And in the 1970s, the economy had a very difficult time. People were growing up and having to go out and get jobs and housing and cars and shoes and refrigerators. And it was a very difficult time for our economy. And you see a 10-year rolling period where stocks didn't go negative, but almost a brutal 1972, 1973, 1974 bear market. And what did you hear people say? Oh, is it too late to get out? Yeah, people don't change. The technology changes. And when you hear people say that, is it too late to get out? That's usually the answer is, yeah, this is the time to get in, right? But nobody wants to get in when the market's fallen 50%. So that was the time to jump in the mid 1970s. We come out of the 1970s with globalization, new technologies, computerization, telecommunications, revolutions, the Cold War ending, global trade, the internet, and we had 10-year rolling periods that approached 20%. And what did you hear people say at the late 1990s? Oh, is it too late to get in? Yeah, it's too late to get in. We had the internet bubble crashing and then the housing bubble crashing, and you have to go back to the Great Depression to see rolling 10-year periods that are negative. And that was the 2000s, a very difficult time for the economy, for at least people investing. I mean, I feel sorry for the people who lost their houses in 2008 and 9 and 10 and 11 and 12. But sure enough, you heard people say, "Oh, is it too late to get out?" Yeah. Look what's going on there. Oh my goodness. We're hearing people start to say, especially not so much with some stocks, yeah. Like the what do they call them, the meme stocks, the ones that were talked about on Reddit and other social media platforms. But definitely with cryptocurrencies and NFTs, you're hearing people say, "Is it too late to get in?" And that usually means it is. Now, does that mean we're going to hit these almost 20% highs again? I don't really know. I don't think so. It doesn't mean I'm right. Doesn't mean I'm wrong. I don't know, but I do know over the long term, assuming the world doesn't end, uh, we should do okay, especially if we keep our eyes wide open, learn some of the techniques that we learn in this class, and then, of course, it's just the beginning, finding which ones work for you, what kind of stocks work for you, think long term, and I'm optimistic. I'm very optimistic about the next 20, 30 years economically, investing wise. I'm very worried, and I've already told you this, about what's going on politically around the world. That scares me. And not only because of freedoms and the like, and liberal democracy, what a horrible name, but that's what it's called. It turns out that liberal democracies, also tend to have the best economies, and the investments tend to be the best. So again, I want to make money. We'll see. That's that. We'll see. Let's hope for the best as always, and do the best we can, and don't listen to liars who believe that the elections were stolen. That kind of stuff. You don't follow the science is now a political slogan, right? It's scary. It's really scary. But economically, I'm excited. The tools that the young generations have now are just amazing. The company SpaceX is a perfect example. In the rocket industry, people told them they're nuts. There's no way you're going to be able to land those rockets. Forget it. And Mr. Elon Musk said, "I'm going to do it. I don't care what you say." And so he hired all young people. They're all young. You look at the videos of the people in front of the terminals waiting for the thing to splash down and land, and they're all young, and you say, "Yippee." I'm optimistic. Historical performance. Traditionally, close to half of the return from stocks was from reinvested dividends. Stockholders used to expect 4 to 6% in dividends each year. That was as much or more than bonds returned in interest, since stocks were considered much riskier than bonds. And from 1936 to 2008, the dividend was averaged 3.8%. But in the 1980s and 1990s, dividends fell to less than 2%, and many companies didn't pay any dividends. Capital gains and growth were what people wanted in the 1990s. So from 1997 to 2007, the average was 1.5%. Half. It touched 1% in March of 2000, the top of the internet bubble. And it's been above 1% since there, but it's gotten pretty darn close at times down to 1%. Right now, it's pretty darn low. Reasons given are some, but again, that's the average of 500 companies, the Standard & Poor's 500, which we'll discuss in a few presentations. Relax. Just a list of companies. There are companies that are paying 4 to 6%. Not too many. There are a lot of companies that are paying 0%. They're growth companies. They need the money to reinvest in the company, reinvested dividends. Reinvested earnings. Reinvested earnings. If they're you accounting students, you know what I'm talking about. If you don't worry about it. If you're the corporation and you distribute your earnings, those are called dividends, which are very cool. Dividends don't lie. If you hang on to them, they're called reinvested earnings, and they are used to sustain the business, grow the business. And there were various reasons. Dividends were taxed at a higher rate than capital gains. Well, that's not true anymore. But anyway, that was true for a while. And so people said, give me capital gains, I'll pay fewer taxes. People wanted the business to reinvest the earnings for growth instead of distributing it to the other investors. Oh, don't send me the dividends. I want you to build the business. Stocks were no longer considered riskier than bonds. This was posited, put forth by several individuals. One gentleman wrote a book in the late 1990s, Dow 36,000, where he said basically that stocks are not as risky as bonds. Boy, was he proven wrong. And when I saw that book, I didn't read it, but I thought I did. I did read some. I read the one part where he was saying that stocks were less risky than bonds. And that's when I said, no, that's not true. That is not true. That is not true. History tells us it's not true, and I bet you future history will, and of course it did. And I said to myself, someday the Dow is going to be 36,000. Someday, but I don't know when, and it ain't going to be in the next couple of years like he thought. Savings accounts were also paying less than 2%. They're paying less than 1% now. And of course, people lost track of their senses and bid up the prices, and that's exactly what happened in the late 1990s. People say that's true now of stocks. Well, I agree with some stocks. Well, actually, a lot of stocks. But there are many other stocks that are not too expensive, as we'll see when we start adding the valuation techniques, the measurements that we look at when we look at stocks. Here is the historical performance of the return on bonds, the yield on bonds, the interest rate on bonds, and the yield on stocks. And as we see, in 1960, they were actually fairly close to one another, 3.8% or so for stocks and 4.4% or so, 4.3% for bonds. And then what happened is in the 1970s, inflation started to take hold as the economy, was trying to deal with this huge bulge of baby boomers. And so investors demanded higher and higher interest rates from their bonds because inflation is a bondholder's nightmare. At the same time, stocks had fallen, so the yield on stocks had gone up substantially. And then in 1979, a gentleman by the name of Paul Volcker was tapped by a president, Jimmy Carter. Yes, dear students, we had a president named Jimmy, to deal with the inflation issue. And he said, Mr. President, we can do it. He appointed him the Federal Reserve Board chairman. But it probably will mean that you'll lose the presidency because we're going to jack up interest rates so high that people are going to go through a painful recession. And to his credit, Mr. Carter said, yes, do it. You do what you need to do. And they did. The Federal Reserve jacked up interest rates. Some of your grandparents, or maybe your parents, will We remember mortgage rates at 17%. It was only for a couple of months, but it was shockwaves. And sure enough, inflation started to just crumble at this, and so did bond yields. So you see bond yields falling and falling and falling, and we see stocks doing very well, the price going up, and so the yield on stocks going down, 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 until finally in 2000, as we said, they touched 1%, and then we had the brutal bear market of 2000 to 2002. So the yield went back up as the prices go down. Meanwhile, the bonds kept falling and falling. And then finally, in 2008, you saw the yield on stocks go above the yield on bonds. Whenever you see that, it's usually a pretty good time to buy stocks, depending on what's going on. And sure enough, that was the time to buy stocks. And it happened again in 2012, and again 2013 was a great year for stocks. So right now they've been fairly close to one another. Right now, this is at the end of 2021. You see the bond is what, like a 1.5%, but now it's over 2%. So bond yields have ticked up as people are afraid of inflation, and stock yields are still pretty low overall. Some companies are paying pretty decent, but not too many. Most companies are not paying very good um, dividend yields, as we discussed in the previous slide. So the pendulum swings. The bear markets of 2000 to 2002 and 2008 have changed investors' perception about dividends. We now see investors in companies focusing more and more attention on dividends. Many companies that never paid dividends in the past are doing so now, so especially tech companies. Some tech companies are paying great dividends, whereas they didn't 20 years ago because they were growing. We need the money. And you get to this situation where some of these companies were built tens of billions of dollars. There's so much cash, they don't know what to do with it. How many times can Microsoft rewrite weird word? They keep making it worse every time they do. And so they got all this cash, and finally Microsoft, I think they had $60 billion in 2003, and they said, okay, we'll start paying a dividend. And since then, they've been paying very good dividends. So the tax law also has changed such that dividends are taxed roughly the same as capital gains. And there's a wonderful saying. It's also a book that this woman wrote. She's actually based in La Jolla. The book's not that great, but I love I use this saying over and over and over again. Dividends don't lie. How do you know dividends don't lie? Because they sent you a check. Every other piece of information that the company gives you in their financial reports and on the internet, whatever, it could all be fantasy. And in some cases it is. Enron, 20 years ago. But you know that dividends are what they are because they sent you a check. Well, they don't send you a check anymore. It gets electronically deposited in your account, but that's the idea. And this is attributed to Mr. Rockefeller. We don't even know if he said it or not because it was attributed by his neighbor. Supposedly, John D. Rockefeller said, the only thing that gives me pleasure is to see my dividends coming in. But I'm with him. Those dividends do give me pleasure. And so we love dividends. Now, you're going to hear other people say, oh, Payano's a fuddy-duddy. We want growth. Well, that's why there's growth and income. Remember the growth and income mutual funds? Yes. So we do want growth, but we also love those dividends. In fact, we love growth of dividends. Just stick with us, okay? Stick with us. You remember bull market and bear market? Have you heard these terms? Let's get them out of the way. Bull market is a favorable market normally associated with rising prices, investor optimism, economic recovery, and government stimulus. Whereas a bear market is unfavorable markets normally associated with falling stock prices, investor pessimism, economic slowdown, and government restraint. And for you entomologists, is that the word for a person who loves the derivation of words? Where did the terms bull market and bear market come from? Well, you'll hear people say bulls charge ahead. They throw their opponents up in the air, whereas bears are more reclusive, and when they attack, they paw, they knock their paws down upon their opponent. I don't think those are the real where they really came from. There's a saying: "Don't sell the bear skin before the bear is caught." And I've read it several times, and I still don't really understand where the term came from. And it's not that important. All you got to know is that bull means the market's doing well. It's a bull market. Bear market, the market goes down. Typically, a 20% down. That's a bear market. If it goes down 5 or 10 or 15%, that's called a correction. Whatever. It's still no fun. But they happen. And so we have to be prepared emotionally for those times when it's not always sunshine and lollipops. So, what are the pros and cons of stock ownership? Right? Well, the pros, the stocks allow the general public to share in the rewards of the business enterprise. They've been the best financial investment returns over time. They've had the best financial returns over time. Dividends and capital gains, both optional. And the real estate people are jumping up and down saying, hey, well, it's a different world, folks. We'll deal with real estate later on. They are very liquid, easy to buy and sell, assuming you buy bona fide companies, which is a fancy word for saying real companies, not these penny stock shams. And we discussed the limited liability aspect of these things in that we buy one share at $100. That's it. That's all we can lose is $100. They can't come after us and say, oh, you have to pay all this money that the corporation owes to these people. Wrong. I don't have to. And then one thing that we don't discuss often is the increased standard of living for all. You know, capitalism might be the absolute worst system ever created by humans except for all the others. It's worked pretty darn well. It's not perfect. We have serious issues. We always had serious issues. One of them is the inequality in our system. That is, some people don't really understand how savage the equality is. You know, we say, oh, some inequality is okay, but the equality has gotten worse. And that's something we're going to have to deal with, because if you don't, then you have situations where we have now, where people are living on the streets, and it's not good. And so we've got to deal with it. And I'm not sure how we're going to deal with it. I know California, we've got this huge cultural issue where people don't want to build up. They don't want to increase the density. But other countries, other states have done it. We can do it. We can do it. I know we can. Now, what are the downsides? Well, they're risky. They're volatile. Volatile is a fancy word for, hey, I lost a lot of money. How was that stock you bought? Oh, it's been volatile. That means he bought it at $11.88 and sold it for 30 cents. Do you know anybody who's done that? I do. I've known him all my life. He's kind of a goofy guy, teaches investments at Southwest. It was a great stock, folks. I mean, I'm telling you, they're going to make artificial blood. They were based here in San Diego, Alliance Pharmaceuticals. And you notice there's no artificial blood at the blood bank. Yeah, they didn't work out too well. And then, of course, the corporate and financial industry hanky-panky. Trucos, travesores. Yeah, that's where the money is. And so there's always going to be accounting gimmickry and fraud and all kinds of ways to separate you from your money. So you have to be careful and invest prudently and with an eye toward long-term growth in companies that have been around for decades and done well in good times and bad times. And I know it sounds like an advertisement. My apologies. So let's now examine volatility. This is actually the year 2021. And so it's 2021 was actually a very good year, even though it was still marked by the pandemic. The stock market kind of went in one direction, up, not necessarily way up, but up. And your $10,000 start off a little rocky, but then, oh my goodness, did okay, and then pulled back. Oh my goodness, oh, you're going to sell? No, you're going to pull up, and then you're going to sell? No, sell now, no, don't. And you actually made 20-some% if you just held on to your money. But it's those jagged drops that where people go, oh, wait, should I sell? Should I sell? No. Don't just do something. Sit there. That's why Warren Buffett often says, you buy a stock and then just let it sit. Buy a mutual fund or buy a stock, and don't second guess yourself. And this is not actually the best chart to show. It's a better one I'm going to show you is from 2020. Of course, the pandemic. Here is 2020. Yes, it is. And sure enough, if you had started at the beginning of the year, everything was looking hunky-dory until COVID hit, and then it went down 30%. In fact, it went down 30%, the fastest it's ever gone down. The fastest it's ever gone down. The fastest bear market ever on record. And then when people realize that, oh, you know what? The economy's not going to dissolve, but a lot of the people are going to die. But you know what? Things are actually not too bad. And so we had the fastest recovery from the fastest bear market ever. So if you were here and you said, oh my God, I got to get out, and you got out at the bottom, then it started to return, and when am I going to get back in? When do I get back in? And there were some reports of investors who did just that, who pulled out here at the bottom. Ooh, is it too late to get out? And they lost all that upside. They lost all that upside. Who knows? Maybe they've never even gotten back in. And I've heard people say, oh, they're all crooks, those bums, especially. So I'll never forget this one woman. I met her at a party, Thanksgiving one year. And this is after Apple had one of its meteoric rises, and then it fell back 50%. And she had bought it around 700, and it was down around 375. And I kept trying, and she found out, I teach this stuff, and I'm a stockbroker. And she kept saying, why does that happen? Why does that happen? I said, you have to look long-term. Apple's a good long-term company. People are still buying their products. And the iPhone's not going away. And she just wanted to she could not let it go. And she had sold after losing about 50%. I don't know if she ever got back in. I never met the woman again. But volatility, folks, you're going to live with it. It's going to happen. Now, we don't know when, we don't know how, but we know it's going to happen. And so that's why we keep a long-term perspective. Cool? Okay. Go back over, make sure you understand this. It's not that hard, folks. There's a lot of material, but it's really not that hard. And we're so proud of you. When we come back, we're going to take a look at the exchanges. Where are stocks traded? What's going on? And we're going to see that the changes that have happened over the last 20, 30 years have been monumental. And it's all due to technology. Are you getting an education? I certainly hope so. We're so proud of you. We're so happy that you're are in our class, and we wish you the best of luck and success. Study hard, bring honor and glory to your friends, family, and coworkers, and Southwestern Community College.